welcome back to FiscalVoyage. My name is Felix, and today's video we're going to talk about 3 dividend stocks to buy and hold forever. These 3 companies are outstanding dividend stocks. They've been growing dividends for over 10, 20 years, 30 years, and they have good dividend yield, and they look to be very undervalued to fairly valued. They present great buying opportunities. But before we start the video with the 3 dividend stocks to buy and hold forever, if you're new to the channel, make sure to hit that subscribe button. And if you like to make money, make sure to hit that like button as well. And check out my free ebook in the description below. So here's the first dividend stock to buy and hold forever. Ticker symbol LMT, Lockheed Martin Corporation. As you can see here, it's going for $364.90. It's up 3.54% today. But you can see what makes this company so attractive right now is that the PE level is at 14.3, much better than the 5-year average. Yield is a very good yield, decent yield at 2.95, much higher than the broader market, S&P, which is about 1.7 or 1.6, I think it is. And the fact that we're looking at dividend company, you can see Lockheed Martin has been growing dividends for 18 consecutive years and it has a 5-year growth rate of 10.39, and their most recent increase was slightly over 8% dividend increase. And you can see it has a good payout ratio of 42.4%, very positive payout ratio. And if we look at the dividend yield is versus the 5-year average, you can see whenever it hit around the 3% dividend yield, it presented good buying opportunity. You can see here in March lows, it was about 3.18. Right now it's going for 2.95. It's close to it, but the fact that it's close to the 3 means to me a good buying opportunity. So let's look at FastGraph and present some of the earnings and projection growth. So here's Lockheed Martin FastGraph. You can see here the company earnings has been very consistent and growing at a very nice rate. And in the most recent years, you can see here 32% in 2018, 25% in 2019, and this year they're expected to grow at 12%. So these are tremendous growth. Throughout the years, they've only had a few years of negative growth. You can see here in 2011, negative 1% growth, and 2003, negative 9% growth. But overall, solid company. And if we put in the price chart here, you can see there's been times where the company was undervalued, which presents undervaluation, where a PE of 15 and under were good buying opportunities. And if we shorten this time period to the past 5 years, you can see here in 2018, the end of 2018, at the end of December, you can see here the company had a PE around 14.89 and bounced back very nicely for 2019. And right now we have a PE of 14.6, so it's lower than the PE of 2018 in December. And that presents a nice buying opportunity now, because if it was to revert back to the mean, which is what the market valuates this company at, about a 19 payout PE ratio, you can see you can have a very good, decent annual rate of return, about 23.6% for the next 2 years. So that's very positive. Not only you have that great annual percentage growth, you have a solid company with an A- credit rating, which is investment grade. The debt to cap ratio is pretty high. I like to see a 50% and lower, but 66% is still manageable because of the fact that the credit rating and the balance sheet for this company is superb. And the fact that this company has been growing dividends even in this year with all the things that's been going on in the election years and things like that, and COVID, this presents a great buying opportunity in my opinion. Great long-term track record. Analysts are expecting 7% growth in 2021 and 7% in 2022. And you can see here, even if it just stays at a multiple of about 15, you can still make a nice annual rate of return of about 11.4. But I don't see that happening. I see this company going back to a 19 or 20 PE multiple and giving you a very nice 23.6% annual rate of return for the next few years. So this is why Lockheed Martin is a great dividend buy right now, and a buy and hold forever type of company. So let's look at the second one. So the second long-term buy and hold dividend stock that I recommend right now is ABBV Inc., ticker symbol ABBV. You can see here $88.98 is up slightly, 0.83%. Overall, this is a solid company. You can see here a P of only 8.4, and the company is expected to grow about 10% to 12% annually for the next few years. So that's very positive. I always like to see it where earnings has a higher growth rate than the price to earning ratios. That's a good positive. Peter Lynch is very big fan of that. And if we look at the yield, 5.89% right now. Outstanding high dividend yield of 5.8, almost 6%. Very attractive at this price point. And the company's been growing dividends for 7 years. But consider this, that ABBV is actually a spin-off of Abbott Laboratories, which has been growing dividend, I think, over 30 plus years. And the 5-year growth rate of 20.8. And they just recently announced a dividend increase a little over 10%, I think a few days ago or last week. The payout ratio is decent at 49%. If we look at the yield for ABBV Labs, you can see here the 5-year average. The company went better whenever it had a yield of 6.3. In March, it had a yield of 6.5, 6.8. Those were attractive opportunity, but right now it still presents an attractive opportunity at 5.89%. So let's look at the fast graph for ABBV. So you can see the fast graph for ABBV. The company has been growing earnings substantially. You can see here 29%, 12%, 16%, 41% in 2018. This year they're expected to grow at 17%, 16% in 2021, and 12% in 2022. And the fact that the current PE is at 8.6 and the company is expected to grow in the mid-teens to high teens for the next few years is very attractive. If we put in the price chart, you can see the valuation is very attractive as well. If the company will revert back to the mean of a PE about 12.9, you can have a total annual rate of return about 42%, which is crazy for the next 2 years. And I totally see that happening because of the fact that the high dividend, the low valuation, the high earnings growth, all positive combination. The S&P credit rating is BBB plus. Investment grade company, good balance sheet. Even though they do have long-term debt to cap ratio of 80%, I like to see this at 50% or lower. But they do have a great substantial cash flow to continue to pay that down. You can see here earnings yield at 11.59. I like to see this at 6.5%, 7% and higher. Very positive earnings yield. Dividend yield, like I mentioned, 5.89. Very, very attractive at this price point. And they had actually just announced their earnings release a few days ago or last week, and it was outstanding. The dividend increase, net income growth, revenue growth, all positive news. So I was very happy with the earnings. That's why the company's it was as low as $80, and it jumped almost now. You saw $88, almost $89, $90 a share. So that's positive. I could see this company hitting 100 by the end of the year. Absolutely. So let's look at the third and last dividend company to buy and hold for the long term. So here's the next dividend stock to buy and hold forever. Johnson & Johnson, ticker symbol J&J. I'm sure you guys heard of this one. It's going for $140.84. It's up 1.55% as of today. And the market has been down for this company in the past few weeks. You can see here it was up at around $150, and now it went as low to $137. Right now it's at $140. The yield is attractive, 2.9%. PE at 17.3 is higher than the other two. But what makes this company so attractive to me right now is because of the fact that it's a high quality company. It's one of the best company, one of the best run company in the world. So if we look at the dividends, they have a standing track record. You can see here 58 years of dividend growth. The 5-year growth rate is lower than the other two, but still very nice, 6.32%, higher than inflation. The payout ratio is decent at 50%. If we look at the dividend yield average, you can see here in March, it almost had a yield of, what we got here, I can't get that part, but about 3.2. And right now, the yield is at 2.91. I highly doubt we'll see that again, but it is higher than you can see here. Whenever it had close to a 3 yield, the price increased, so that lowered the yield. So anytime Johnson & Johnson goes near a 3 yield or higher, those are great buying opportunity. So let's look at the fast graph for Johnson & Johnson. Here's the fast graph for Johnson & Johnson. You can see here, this is a solid company. Even through the financial crisis in 2008, 2009, the company grew earnings 10%. In 2009, 2%, but growing it slightly throughout the years until 2018 and 2017 when it had 8%, 12% growth. And this year, it looks like the only year in the past 20 years where the company is going to have a negative earnings growth of negative 8%. So it went from $8.68 in earnings in 2019 to $8 in 2020. But they're expected to pick up in 2021 to $8.95, which will be higher than 2019. So that's very positive news at 12% growth. In 2022 is going to grow about 9%. So that's very attractive. So but if we look at the price and add the price to the fast graph here, you can see here that the company tends to follow the blue line, the normal multiple of 17.7, and where any time is under 17, it looks to be a good buying opportunity. So if we show in this time period, you can see here the company right now is 17.10, and if it continues at this 17 multiple, you can have a decent annual rate of return of 10.8%. It's not outstanding as the other two, like Lockheed Martin or ABBV, but it's because of the fact that this is such a high quality company, I think is a good buying opportunity right now. S&P credit rating of AAA, high investment grade rating, outstanding. Low long-term debt to cap ratio of only 31. The earnings yield is low. I like to see a 6.5% to 7% or higher. But again, because of the fact that the valuation and the yield is almost at 3, I think this presents a good buying opportunity for those who don't own Johnson & Johnson and want to open a position. I think right now Johnson & Johnson is a good buying opportunity now to take advantage. And again, if the stock goes lower, what you want to do is continue buying more because of the high quality company Johnson & Johnson is. So even if it will revert back to a 15 multiple, you still make a decent annual rate of return of 5.6. But Johnson & Johnson is such a company that it will revert back to a mean of 17, and I personally think it'll go up to 20 PE, which would drive this total annual return a little higher. But overall, Johnson & Johnson is what Warren Buffett calls a high-quality company at a fair price. So whenever you find high-quality company at a fair price, you buy those companies. And if it goes lower, you just add more shares to it because it's going to be a long-term hold and buy at current prices. So you're looking at this company for the next 10, 20 years. So there you have it. Those are my 3 dividend stocks to buy and hold forever. They present good buying opportunity. ABBV, Lockheed Martin are very undervalued. Great buying opportunity. Johnson & Johnson looks to be fairly valued. Again, this is one of those Warren Buffett famous quote where you purchase. It's good to buy a fair, high quality company at a fair price. So Johnson & Johnson fits that category perfectly. I think it presents a good buying opportunity. And if it goes lower, buy more shares, absolutely, for Johnson & Johnson. But the other two are good buys right now. You saw the potential annual rate of return about 20% to even 40% with ABBV. The dividend yield for ABBV is excellent. They just announced the increase over 10%. Lockheed Martin dividend yield is good, very respectable, and they grow it at a very nice rate as you saw. I hope you enjoyed this video. If you did and you'd like to make money, make sure you hit that like button. And if you're new to the channel, hit that subscription button for more videos like this. And I'll see you guys in the next one.